Hi, and welcome back to my channel, My Tax Guide, where we discuss all things tax to get ready for the up and coming 2023 filing season. Couple of quick announcements. One, I want to thank everyone who is they already on the channel, sharing and subscribing and liking all the videos and giving me feedback on how to improve the channel. I want to thank you very much. Keep hitting that like button, is greatly appreciated. I will not make my goal for 1,000 subscribers, but I'm still going to be aiming for it all the way to the end of the year. So keep on liking and sharing as we are getting ready for this filing season. And I really want everybody to have a good and productive and positive season, hopefully without too many hiccups. The other thing is, hit that little bell at the bottom. Every time I post a video, you'll get an announcement or you'll get a alert in your email, sometimes even on your cell phone as if your notifications are going on, but it will let you know whenever I post a video so you can jump right in and be the first to view it. Hopefully get some good information out of it. With that being said, I want to jump into something that's very pertinent for everyone getting ready to file, which are some of the tax inflation adjustments from the tax year, for the tax year, I should be saying, 2022, that the IRS has released. These are the things that have been solidified. So when you get ready to do your taxes, these are the things that is going to be there. Now, of course, the thing that most people are going to want to know about is what's going on with the credits that 90% of people look forward to. And for the most part, those credits are going to begin to increase. And of course, at the top of that list, I'm going to start with the earned income credit, which is now going to be maxed out at $6,935 for taxpayers who have 3 or more qualifying children, up from $6,721 the year before. And which is, I gotta say, phenomenal. So that's actually a good thing. The table pretty much lays out how the EITC is going to work for other categories, but just to let you know, you do still have the ability to qualify for earned income credit even if you don't have children. So don't think that it's only just the people with kids that's going to get it. Even if you don't have kids, you can still qualify for it depending on your income level. There are income phase-ins and phase-outs, which I'll probably go over in another video. Right now, that is your increase. For tax year 2022, the monthly limitation on the qualified transportation fringe benefit is going to be raised to, and parking increases is raised to $280. And that usually will go on Form 2106. And that form usually flows directly to your state. So hopefully you're taking advantage of it if you're paying any out-of-pocket qualified transportation expense. Now, those things are typically in relation to your employment and are not things that is reimbursed. So if your employer offers a reimbursement plan that you participate in and you're getting some of it back, but it doesn't quite cover everything, there is a credit there that you're allowed to take. So that's actually a good thing. 2106 is a great form, but just be aware that a lot of those things, depending on your state, and we're in one of them, will give you a little bit added benefit. States like Nevada, Washington, Texas, Florida, there is no state taxes. So unfortunately, as far as like the individual is concerned, so unfortunately, you're not really gonna qualify for that because your state doesn't offer it. Sorry. Now, for the people with the lifetime learning credit, the income guidelines have changed. Now, I was talking about this with some people a few years prior, so I knew that eventually this was going to happen because there's a lot of things on the table when it comes to education. So in order to make some things balanced, some things have to be taken away. And this, my friends, will be one of them. Now, the amount used to calculate your MAGI, or your modified adjusted gross income, it is going to be lower for the lifetime learning credit. So before it was $90,000, it is now being dropped down to $80,000 and $160,000 for joint returns. So that basically means that if you're a single filer and you know someone who has a child who they're claiming they're in, say they're getting a master's degree within a vocational school program, a trade school basically, or they're doing qualified on-the-job training. There are certain things, yes, there's certain training you can do at work when it's coming from a higher institution that would qualify for the lifetime earning credit. But if the person claiming them is making more than $80,000, they no longer get the credit. Joint returns used to be $180,000. It is now down to $160,000. They will also no longer get the credit. So that's something to keep your eye out on if you're paying for school and you're in your post-secondary part of schooling. So just let you know that is something that is I would say it's more of a negative effect, but again, it's kind of a balance. So they give and they take. There are, again, a lot of things out there for education right now. So, you got to take the good with the bad. For tax year 2022, the foreign earned income exclusion is now $112,000, up from $108,700. Now, for all my friends who are expatriates, whose earning income from a company that's effectively connected income, where you're going to be overseas working, but you're still being paid by the company, just business in the U.S., this is going to affect you. This is also for people who are, of course, residents in another country, but you're working for a company that's based in the U.S. Yes, you must still file a U.S. tax return, believe it or not, and you get to exclude the first $112,000 of your earned income. Now, notice there's a thing there where I say earned income, because a lot of people think that will include your dividends and interest, and I'm here to tell you it does not. There is earned income, and then there's deferred or unearned income, as it can be known in more, accounting circles and stuff like that. There's a lot of names for that stuff, by the way, but that stuff doesn't apply. So if you think that your bank interest that you're getting is included in that exclusion, no, it's not. You can make $100,000 and still have income that you have to pay because you're getting interest. The next change that I have up for you guys is the estates of decedents who died during 2022 have a basic exclusion amount that has increased from $11.7 million to $12,060,000. The reason why this is important is because people were complaining that the estate tax was going to kick in if they inherited any property, and they don't feel that it was fair for them to get a tax bill essentially for something that's basically a gift from someone who passed away. So now that exclusion has increased to $12,060,000. This does not mean, however, that there aren't going to be certain tax issues. There are certain things, like if the decedent had actually earned income before passing, you may still have to have that estate. You may still have to file a tax return for that decedent, even though they're not around to collect whatever refund, or they're not really there to pay the tax bill. That may still have to come out of the estate. So don't think that it's like, oh my God, I don't have to worry about it. No, you'll still might have an issue or two, but the most important part of all of this is that if you have a estate that you gain through a value of a high value, you can essentially get a good portion of it excluded for taxes, which is great. But remember, this is the federal level. So there are certain states, New York of course being one of them, that has decoupled from the IRS tax rules. So you have to be careful about these sort of things also. You have to keep in the back of your mind that, federal tax law and state tax law, depending on where you are, will change. So while this is for the federal and this will alleviate you from the federal side of things, the states may have their own guidelines that may be completely different. So the best thing to do is to check with your tax preparer or accountant in the state that has knowledge of these things, and make sure that you don't end up with a tax bill. Next up is the maximum credit allowed for adoptions. This has actually increased from $14,440 to $14,890, which is fantastic. This is one of those things where it's really sort of the government's way of saying, hey, you're out there doing something great for someone, whether it's a family member or a complete stranger or whoever, and you're really trying to make a change in their life. This is the government's way of saying good job on taking on a child that was not born yours, but you want to take responsibility for them. Now, there are some exceptions to this, and those exceptions will still apply. And again, I'll probably go over those in a later video. There are a couple of things, even with that, there are certain adoptions that basically, I'm gonna be honest, they do not qualify for this. It didn't qualify for the 14,440, so the increase really isn't gonna affect them. But again, I'll go over that in a later video. Another thing that has increased is your 401k contribution limit has increased to $20,500. You're usually limited to the amount of money you can contribute, even if you go 10% of your salary or 15% or 20%. Well, there was always a cap on exactly what that number is. The same way there's a cap on your IRA and your Roth IRA contributions. There are caps in those things and income restrictions. Well, the same thing for your 401k. But so the limit, of course, is now increased to a $20,500 contribution on your side. So that's the max you can put in there. Always be aware that if you have a company that you're working at and they're doing 401k and they're going to match your contribution 100% up to whatever percentage they say it is. You go ahead and put that max percentage in. Because I'm gonna be honest, to this day, there are not a lot of things you can put money in where someone's gonna say, hey, if you end up having to put in $100 in, I'm gonna put in the same $100. There's really no one else that'll be doing that. Now, the marginal tax rates, basically those wonderful percentages that lets us know how much money do you really have to be paying for what you're earning. Well, those percentages have changed a little bit, but the top rate has not changed. So the top rate is still 37%. That is from the TCJA, which was Donald Trump's tax changes before he, I want to say about a year into office, he came up with this. So basically, a lot of that stuff is still in effect. To be honest with you, a lot of the TCJA will be in effect for years to come. We'll more than likely have another election, another presidential cycle before we're even done with a lot of this stuff. And what's crazy is some of this stuff does become permanent even in 2025, but the president that gets elected that year is gonna have his hands full because he's got to come up with basically a replacement for a lot of stuff that's already in here. So he's basically got to look at this and work this out with like House Ways and Means, the IRS, the Treasury Department, and figure out how to make the tax law work, because a lot of these changes are not permanent. Some are, some aren't, and the ones that aren't, trust me, you're gonna see the difference. Now the tax rates, of course, have changed. So now for the top tier, for individual taxpayers, which is what we call your single taxpayer, which would include your head of household, that will include your qualifying widows, and of course just basic singles. The income, $539,900 and greater, $647,850 for married filing joint. That top tier bracket is 37%. So once you are over those numbers, you are in the top percentile. That is your rate. You also have 35%. That 35% rate is for incomes between $215,950 and the $539,900. Now it's $431,900 for a married filing joint. For incomes, 32%, it's $170,050 $340,100 for married filing joint, 24% for incomes $89,000, and that'll end, of course, at $170,049. That's where you're going to be capped at 24%, $178,150 for married filing joint. 22%, $41,775 up to $89,074, $89,074, $83,550 for married filing joint. The 12%, which is one of the lower incomes, is the $10,275. If you're over $10,275, $20,550 married filing joint, you're in the 12% bracket. Now, for everyone who is below $10,275, you fall in the 10% bracket. Or if you're married filing joint and you're making less than $20,550, you also fall into the 10% bracket. Okay, so you guys got to keep in mind, like, these brackets have changed. It does mean some things for some people, but basically you have to pay attention, especially when it comes to like earned income credit, the foreign tax credit inclusion, and something I'm getting ready to mention, which is the AMT. These things are very important. So knowing which bracket you're going to fall in, where your income falls at, for your taxable income and things like that, there's a good reason to know these things, and this tells you where you're basically going to land. So as your income is increasing, so does your percentage you have to pay. And when your taxable income goes over a certain dollar amount, that's where you're going to land, essentially. So it's good to be aware of that. Of course, there is no limitations on itemized deductions. Tax Cuts and Jobs Act, the TCJA, eliminated the limitation on itemized deduction. Yes, the Schedule A altogether used to actually have a limitation. That has been lifted. But within the Schedule A, those limitations are still there. They have not gone anywhere. So you're still stuck with 7.5% for medical that you basically have to eat before you can actually take any deduction. You still capped at $10,000 in your state tax deduction that you used to be able to get on your federal tax return, things like that. So the charity, the 50%, up to 50% of your gross income, 30% of qualified property, things like that. All of that stuff is still there. It has not gone anywhere. So don't think that you have unlimited amount of itemized deductions. You don't. And still, the transportation expense, job deductions, on the job deductions, essentially, all those things are still gone. They're not making a comeback. If I'm not mistaken, that's one of those permanent changes. It's not coming back unless there's an act of Congress. So, if you want it back, I just say, hey, write your local congressman. The alternative minimum tax for year 2022, the exemption starts at $75,900, and it begins to phase out at $539,900, and of course $118,100 for married filing joint. Begins to phase out at $1,079,800. Now, that exemption basically means that once you're over the $539,800, dollar for dollar, that exemption, the $75,900, dollar for dollar, that decreases. So as you go up, it goes away, and it's completely gone once it's used up. So that exemption is a big thing. Now, AMT is something I'm actually going to go over in another video because it's a little bit more complicated than regular tax, and people will be surprised. A lot of people qualify for that, and they should be filing that, but they don't. And it's kind of a thing depending on what your tax liability is, and that's really what it comes down to. Some things get removed, some things you get to keep, and there's a requalification. Okay, so I want to thank everybody for listening in and getting ready with me for this upcoming season. Now, the last thing I'll say before I close out for tonight is this is a time really to focus on what you really want to do with your tax return. A lot of people feel like it may be a little early. It's really not. It's the end of the year. There are tax issues that's going to happen, but waiting until you actually file your tax return, I say this all the time to my clients and to you guys who subscribe to me, waiting till the end is like the biggest mistake you can make. The best thing you can do is to plan ahead. Talk to your preparer, talk to your tax advisor, talk to your accountant, talk to the person that's going to be responsible for helping you prepare your tax return so that you get the best return that you can and that you're mitigating as much as any tax liability as you possibly can before April 15th. With that being said, my name is Sumana. I am your tax guy. Thank you for listening in, and I'll see you next time. Bye.